Hey everyone. Ready for a deep dive into something kind of unsettling?
Oh, yeah. This should be interesting.
Well, we're looking at this report from Bank of America, and
Yeah?
they're predicting a pretty significant market downturn.
Uh,
And it's not just like a little dip. They're talking about a potential 40% crash.
wow.
I know, right? And they're comparing it to past market bubbles, like the Nifty 50 and the dot-com boom.
Oh, wow.
But don't worry, we're not just here to like freak everyone out.
Yeah.
We're also going to be looking into Bank of America's recommended safe haven investments,
Okay.
especially dividend stocks.
Interesting.
Yeah.
Yeah.
We're talking about big names like Coca-Cola,
Oh, well.
Warren Buffett's favorite,
Yeah.
and substantial dividends and
Yeah.
companies that are built to withstand a recession.
Okay, this is fascinating. So Bank of America is giving us a warning, but also some potential solutions.
Exactly. So let's unpack this.
Okay.
Why does Bank of America think the market is headed for a crash?
Well, they're pointing to the S&P 500's current price-to-earnings ratio.
The PE ratio.
Exactly, and it's at 28.77 right now.
Okay.
And that's a lot higher than the historical average,
We did.
usually around 17 to 18.
So a high PE ratio is like a sign that the market might be overpriced.
Yeah. It means investors are paying a lot for each dollar of earnings.
It's like paying extra for a slice of pizza just because everyone else is doing it.
Right. And there's more to it than just the PE ratio.
Like what?
Well, what about those giant tech companies everyone's talking about?
You mean the Magnificent Seven?
Exactly. We've seen this before, haven't we?
Like in past market bubbles.
Yeah, where a few companies drive the market way up.
And then everything comes crashing down.
Right. And this time we have something else going on too.
What's that?
Passive investing. People are putting tons of money into index funds that automatically buy those big tech stocks.
So it's like adding fuel to the fire.
Exactly. One analyst, Jared Woodard, he's specifically saying those new economy stocks could trigger a domino effect.
And take the whole market down with them.
Yeah, that's where that 40% crash prediction comes from.
So what are we supposed to do? Hide all our money under the mattress?
Not exactly. Remember, Bank of America is also suggesting these safe haven investments.
Right, the dividend stocks.
Yes. Since 1926, dividends have actually made up a good chunk of the S&P 500's returns.
How much are we talking about?
About 32%. It's not just about the share price going up.
It's about that steady income from dividends.
Exactly. Think of it like owning a rental property.
You get rent checks even if the property value goes down.
Exactly.
So it's like a safety net during those market ups and downs.
Exactly. And that's why Bank of America is recommending companies with a history of strong dividends and stable earnings.
Companies that can handle a recession.
Right.
So who are these dividend superstars?
Well, let's start with a classic, Coca-Cola.
Ah, the real thing.
And Warren Buffett owns a lot of it,
Like a lot.
like 400 million shares.
Wow, 400 million. He must really love his cherry Coke. Okay, but seriously, what makes Coca-Cola such a safe bet in a shaky market?
Well, they have a 2.82% dividend yield.
Okay.
So let's say you invest $10,000. You could potentially make $282 per year just from those dividends.
Wow, okay, that's not bad.
And they have over 500 beverage brands.
Really?
Yeah, they reach 200 countries and sell almost 2 billion drinks every day.
They're everywhere.
Right. Global reach, market dominance.
Makes sense.
Oh, and UBS actually gave Coca-Cola a buy rating.
Really?
Yeah, they set a price target of $78 per share
Okay.
because of Coca-Cola's strong cash flow.
Makes sense. Even if the market crashes, people are still going to want their Coke. So that's next on Bank of America's list.
How about ExxonMobil?
ExxonMobil, the oil giant.
The one and only. They operate in over 40 countries.
And they have a pretty attractive dividend, right?
Yes, 3.66%.
Okay.
And with oil prices going up right now,
Makes sense.
it's looking even better.
Yeah, they've been making some big moves lately, too.
Oh, yeah.
Like that huge deal they made to acquire Pioneer Natural Resources.
I remember hearing about that, like almost $60 billion, right?
$59.5 billion to be exact.
Wow. So what was that all about?
Well, it basically locks in decades of low-cost oil production for them.
So they're thinking long term.
Exactly. They're not just riding the current energy wave, they're setting themselves up for the long haul.
Smart. And what are the analysts saying about ExxonMobil?
Well, Jeffries thinks their shares could hit $140.
$140.
Yep.
What makes them so confident?
ExxonMobil's commitment to shareholder returns.
Okay, so we've got Coca-Cola with its global reach, ExxonMobil riding the energy wave. It seems like Bank of America is recommending companies that can both hold their own and grow, even if the market takes a downturn. What other companies do they like? How about Prudential Financial?
Prudential. I mostly know them for insurance.
Yeah. but they have a lot more going on.
Hmm.
And their dividend yield is amazing.
Oh, yeah, what is it?
A whopping 4.84%.
4.84%. Wow. Okay, but can they really maintain that if the market tanks?
That's where their business model comes in.
Okay, what's so special about it?
They do more than just insurance. They're also in retirement planning, group insurance, and investment management.
Oh, so they're not putting all their eggs in one basket.
Exactly. They're diversified, which means they're more stable even if one area of their business isn't doing so well.
That's smart. So they're diversified. Anything else?
Oh, yeah. Their asset management arm, PGM, manages over $1.5 trillion in assets.
1.5 trillion.
Wow.
It's like a fortress.
So it sounds like Prudential can handle whatever the market throws at it. What do the experts think?
Jefferies gave them a price target of $152 per share.
Oh, wow. Okay, so they like them.
Yeah, they really praise their stability. So strong dividends, a diversified business model, and the experts are on board.
It's like the quiet achiever of the investment world. So we've got Coca-Cola, ExxonMobil, Prudential. Who else is on this list of dividend superstars?
Okay, last but not least, Verizon.
Verizon. Interesting. Yeah. They're trading at a low 8.75 times earnings.
Low. Why is that?
I don't know, but that means you're getting a lot for your money.
Especially when you consider their dividend, right?
Yeah, it's a hefty 6.61%.
6.61. That's the highest so far. But why are they trading so low? Should we be worried?
I don't think so.
Yeah.
Verizon has this steady demand for wireless services.
Yeah, everyone needs a phone.
Exactly. And with the rollout of 5G, that demand's only going to grow.
So they have really reliable cash flow.
Exactly. And that helps them keep those dividends coming.
It's another one of those essentials, right?
Right. People might cut back on other things during tough times,
Mm-hmm.
but they're probably not giving up their smartphones.
Makes sense. So what are the analysts saying about Verizon?
Well, Citigroup called it a must-own stock for income investors,
Wow, okay.
and they think it could reach $49 per share.
Okay, so we've got 4 solid picks from Bank of America.
Uh-huh.
Strong dividends, stable businesses, and they seem like they can handle whatever the market throws at them.
Yeah.
But wait a minute. The original source mentioned 5 stocks, right?
Oh, yeah, you're right.
Where's the missing 5th? Did they just forget about it?
It seems like there's some missing information in the report.
Hmm.
We only have details on these 4.
Oh, that's frustrating. But if anyone out there is curious, you can always try to track down that mysterious 5th stock.
Yeah. Good luck.
Okay, so back to the big picture. Bank of America is predicting this pretty scary 40% market crash,
Yeah.
but they're also recommending these dividend stocks as a potential solution.
Yeah, it's interesting. What do you think about all of this? Are you buying into their prediction, or do you think they're being too pessimistic?
Well, it's tough to say for sure. Market predictions are never guarantees.
Yeah, there are so many things that can happen.
Exactly. But Bank of America's concerns are valid. We've seen these bubbles before.
So it's not about panicking, it's about being prepared.
Exactly.
Yeah.
And that's where those dividend stocks come in.
They're not a magic solution, but they can help us ride out the storm. Right. It's all about diversification, having a mix of investments that fits your risk tolerance and your financial goals.
So let's quickly recap those 4 dividend stocks.
Okay. First up, Coca-Cola.
The global beverage giant, 2.82% dividend yield, and Warren Buffett loves it.
Next, ExxonMobil, 3.66% dividend. They're in a great position for the long haul.
Then there's Prudential Financial, 4.84% dividend, super diversified and stable.
And last but not least, Verizon, 6.61% dividend. They provide an essential service that's only going to become more important in the future.
It's a great reminder that these are just suggestions, not financial advice.
Definitely. Everyone should do their own research.
Talk to a financial advisor if you need to.
Absolutely.
Don't just blindly follow anyone's recommendations.
Make informed decisions that are right for you.
It's been a fascinating deep dive so far. We've talked about the market, the risks, and some potential ways to navigate it all.
It's amazing how much there is to learn about all of this.
I'm already looking at dividend stocks in a whole new light. I'm definitely seeing the appeal, but I'm still curious about what makes Prudential stand out.
Well, think about their asset management arm, PGM.
PGM?
Yeah, it's huge. They manage like $1.5 trillion in assets.
1.5 trillion.
It's like their own financial fortress.
That's a lot of security. What are the analysts saying about them?
Jefferies actually gave them a price target of $152 per share.
Wow, so they're optimistic.
Yeah, they really like Prudential stability. So strong dividends, diversified business, and the experts are on board. It's
Yeah.
pretty impressive.
It's like they're flying under the radar. Okay, so we've got Coca-Cola, ExxonMobil, Prudential. Who else is on Bank of America's list?
Let's talk about Verizon.
Verizon. Interesting. I know them for their wireless service. Yeah.
Yeah, and they're actually trading at a pretty low 8.75 times earnings right now.
That's low. Is that a red flag?
Not necessarily. It just means you're getting more for your money.
Especially when you consider their dividend, right?
Right. It's a whopping 6.61%.
6.61. That's the highest we've seen so far. But I'm still curious. Why are they trading so low? Should we be concerned?
I don't think so. Think about it. Verizon has this consistent demand for their services.
Everyone needs a phone these days.
Exactly. And with 5G rolling out, that demand's only going to increase.
That makes sense. So they have a really reliable cash flow.
Yeah. And that helps them keep those dividends coming.
It's another essential, right? Like people might cut back on other expenses, but they'll probably keep paying their phone bills.
Exactly. And Citigroup seems to agree.
Yeah.
Yeah. They called Verizon a must-own stock for income investors.
A must-own, huh? They must be pretty confident.
Yeah. And they think it could hit $49 a share.
Interesting. Okay, so we've got 4 really solid picks from Bank of America.
Yeah.
Strong dividends, stable businesses, and they all seem pretty resilient even if the market takes a hit.
Definitely.
But hold on a second.
What is it?
The original source mentioned 5 stocks, right?
Oh, yeah. That's right.
Where's the missing 5th?
It looks like there's some missing information in the report.
Oh, that's annoying. So we only have details on these 4.
Yeah, unfortunately.
Well, that's too bad. But hey, if anyone out there is feeling adventurous,
Yeah.
you can always try to track down that mysterious 5th stock.
Good luck with that.
So back to the big picture. Bank of America is painting this pretty grim picture of the market's future.
Yeah, that 40% crash prediction is pretty scary.
It definitely got my attention. But they're also giving us these dividend stocks as a potential lifeline.
Yeah, it's interesting. What are your thoughts on all of this? Do you think they're being overly pessimistic, or are you taking this prediction seriously?
Well, it's tough to say for sure. Market predictions are never perfect.
Yeah, things can change so quickly.
Exactly.
Yeah.
But I think Bank of America raises some valid points.
Yeah, and we have seen these kinds of bubbles burst before.
Right. I think the key takeaway is to be prepared.
Not to panic.
Exactly. And those dividend stocks can definitely help with that. They're not a magic solution, but they're like a buffer against the market's ups and downs.
Right. And it always comes back to diversification, having a mix of investments that aligns with your risk tolerance.
And your financial goals.
Exactly.
Okay, so let's do a quick recap of those 4 dividend stocks.
That's good.
First up, Coca-Cola.
The global beverage giant, 2.82% dividend yield, and Warren Buffett loves it.
Then there's ExxonMobil.
The energy powerhouse, 3.86% dividend. They're really playing a long game.
Next up, Prudential Financial, 4.84% dividend. Super diversified and stable.
And finally, Verizon, 6.61% dividend, providing an essential service that's only getting more important.
It's a good time to remind everyone that these are just suggestions. They're not financial advice.
Exactly.
Everyone needs to do their own research.
And talk to a financial advisor if you need to.
Make informed decisions that are right for you. Don't just blindly follow any recommendations.
Absolutely. Think for yourself.
It's been a really interesting deep dive so far. We've talked about the market, the risks, and some potential solutions.
Yeah, it's fascinating stuff.
I'm already thinking about dividend stocks in a whole new way.
Yeah. It's like we've opened up this whole new world of investing,
Yeah,
one that's all about building a strong foundation.
exactly.
We've talked about these market patterns,
Yeah.
the risks of a bubble, and those reliable investments that can weather any storm.
Right, those companies that can hold their own.
And that 40% crash prediction.
Yeah,
It's a little intimidating,
I know.
but we've also learned about those dividend stocks
Right.
that could help us navigate through it.
Exactly. It's not about being scared, it's about being prepared.
Right. Knowledge is power, right?
Absolutely. The more you understand about how the market works,
Yeah.
the better decisions you can make.
And it's not about timing the market perfectly.
No.
Or finding that one magic stock.
It's about the long game.
Right. It's about building that solid financial future.
Exactly.
So what's the most important thing our listeners should take away from this? I think the biggest thing is don't let fear control you.
Yeah.
Use this information to your advantage.
Okay.
Take a look at your investments, think about your goals, and make adjustments if you need to.
So, like, maybe it's time to explore those dividend stocks.
Yeah, see if they fit into your plan.
Or maybe this deep dive has inspired you to learn more about the market.
Right. Learn how to spot those bubbles
Yeah.
before they burst.
It's all about being proactive.
Exactly.
And you don't have to figure this all out on your own.
Right. There are so many resources out there.
Yeah, financial advisors, online platforms, all sorts of things.
Exactly. Find someone you trust get some advice.
Yeah, personalized advice. That's right for you. Well, I think we've covered a lot of ground today.
We have.
We talked about that market prediction, dove deep into dividend stocks, and hopefully gave our listeners some valuable information to think about.
It's been a great discussion.
I always love exploring these topics with you.
Me too. It's fascinating.
And of course, a big thank you to all of our listeners for joining us on this deep dive.
Yeah, thanks for listening.
We really appreciate your curiosity and your willingness to learn with us.
We couldn't do it without you.
Now, before we wrap up,
Yeah.
I want to leave everyone with one final thought.
Okay.
We've been talking about this potential 40% market crash.
Yeah,
And it sounds pretty scary.
it does.
But what if we thought about it differently?
How do you mean?
What if instead of fearing it,
Yeah.
we saw it as an opportunity?
Ooh, I like that.
An opportunity to buy those undervalued assets.
Okay.
To maybe rebalance our portfolios
Yeah.
and set ourselves up for even bigger growth in the long run.
Right. It's all about perspective.
Exactly. Those market dips,
Yeah.
they can be scary,
Yeah.
but they can also be the best time to buy.
If you're prepared.
Exactly. That's such a great point. Even in the face of uncertainty, there's always potential for growth
There is.
and opportunity.
That's right.
Thanks for reminding us of that.
Of course. It's always a pleasure chatting with you.
And to all our listeners out there, thanks for tuning in.
Yeah, we'll see you next time.
Keep learning, keep exploring, and happy investing, everyone.